Hi, good afternoon. Thanks for watching Cordant Wealth's market update for Monday, November 16th. Today we're going to be looking at where the market is year to date. We're going to be looking at health and economic data, and we're going to talk about the reflation trade. So what is that? What's driving it? And what does that mean for the market and performance in some different areas? First of all, though, we're going to play a little bit of a quiz here, a little bit of trivia. So question is, from the market bottom on March 23rd, would you rather own Pfizer, which is the first company to come out with a vaccine to treat COVID-19, a successful vaccine, tech stocks, which broadly have benefited from the environment we've been in this year, people working from home and using their services more, the broad market, S&P 500 large cap stocks here in the US, or small company stocks, many of which have been more impacted financially and in areas and sectors of the market that have been more impacted by the environment this year. So from the market bottom, March 23rd, what would you rather have in your portfolio, or which would you have rather bought? Pfizer, tech stocks, the broad market, or small company stocks? Think about that, maybe jot down your answer, and we will reveal the answer to the question here at the end. Markets year to date, so we've looked at this chart over the course of this year, but had the big drop between February and March of about 34%, had a 60% rally through September 1st, and then since then have kind of stayed in this range from the high of September 1st, drop of about 10%. Since then, we've had a pretty nice bounce back where we've actually made some new highs in the market. So starting to move outside of that range. But that's the path we've traveled so far this year in the markets. From a health perspective, obviously, COVID is back front page news. I mean, it's pretty much been there all year, but we're starting to see new cases spike around the country, hospitalizations high, new freezes, lockdowns being put in place to slow the spread and slow the hospitalization. So that's the situation we're in. The markets seem to be looking kind of through that, past that right now. Some of that is, looking on to next year when the vaccine is in place and when things hopefully get back to normal. So that's where we are from a health perspective. From an economic perspective, the data continues to come in essentially better than consensus or better than expectations. Obviously, we had this huge spike, a really low bar in terms of economic expectations early part of the year and exceeding that, which you can see up here. We're still, anything above zero means better than consensus. And so still seeing economic data come in better, which is part of the fuel that's been driving the market this year. Mentioned at the beginning this reflation trade, and we're going to take a look at what that is. But first, a little bit of an analogy from one of my favorite movies. So most of you are probably familiar with this image. This is from The Shawshank Redemption, a movie made about 25 years ago now. In it, Andy Dufresne here that you're looking at, has been in prison for many years and ends up tunneling out of prison, and that's his escape. But to do that, basically, he had to crawl through 500 yards of a sewer pipe to make its way out. And so the analogy is, I think we're in an environment here with we're in this period of a health crisis where we can sort of see the light at the end of the tunnel, right, with a vaccine around the corner, but we still have to get through this period. We still have to crawl through the sewer pipe to get through the other side. We have to go through this winter, cases spiking, hospitalization spiking. We have to get through that period, but from a market perspective, I think they're looking at the bright light at the end of the other side of the tunnel, and that's what the market is banking on. But we still need to live through this period and get through this period to the other side. So that's kind of the setup for this reflation trade. What's new? What's driving that? A couple things. So one, obviously, is the vaccine. The other is the outcome from the election, which was driving a lot of uncertainty this year. So these two things, we looked at earlier this year, the election and the impact on the market. With some certainty there, we have basically ruled out two of the scenarios, the status quo and the blue wave, and it looks like we're going to get something more like a gridlock scenario. Obviously, we've got a few outcomes of some elections to go, some Senate races in Georgia that would determine who controls the Senate, but it looks like we're going to have split control between the executive branch and the Senate and the House. So this is that gridlock scenario that we looked at over the summer. So this will actually, if you remember, had the most upside for markets, 4%, which we've done since the election. And I think some of the things that the market likes about this outcome is lower trade risks, increased predictability, and maybe importantly, no new taxes from a market perspective. Without control of the Senate, it doesn't look like the ability to pass substantial tax changes would be there. Potentially one of the cons from a market perspective, however, would be higher regulation, which could still be done under the current setup. So that's where we are from a political perspective. From the other side of that is the vaccine, obviously, and having that around the corner. So what is this sort of reflation trade? You're starting to see some rotation in the market from this scenario that we've been in, sort of this deflationary scenario, to this reflation or a growth scenario. So what does that mean? What have we seen? So you're starting to see, and we're going to look at some charts that sort of back all this up, but what we've seen, interestingly, in the market since really sort of September, but certainly since the election, has been previously this year, things on the left: growth, large cap, tech, rates have been dropping, credit spreads widening, gold. These have been good places to be. Now we're starting to see a shift. So it's not so much growth now, it's value. Small caps outperforming large over the last month or weeks, certainly. Energy materials replacing technology as areas of the market that are doing better. Interest rates are going up. Credit spreads are coming down. Oil and copper, from a commodity perspective, are doing better than gold, which tends to be more of a flight to quality or a trade like that. And so what you're seeing, sort of this rotation in the markets more broadly, but you also see like sort of almost day to day. If tech is up, typically, interest rates are falling and there's concerns about growth prospects of the economy. When rates are up, value and small caps have tended to do better of late. So kind of an interesting rotation. If you sort of look more in depth below just sort of the headlines of the market up or down, these are the things that have been kind of like back and forth day to day. So this will be interesting if you're interested in sort of paying more attention to sort of what's going on day to day in the market and how the news are affecting things. Something that I've certainly kept an eye on and been paying attention to. So some slides to show you what's been going on. One of the things, just in getting some certainty around the election and certainly a vaccine, volatility has just really cratered. So we peaked late October with a VIX, which is the measurement of volatility on the market, at 40, which is essentially implying that the market could be up 40% or down 40% in the next year. That's the range of outcomes that a VIX of 40 would suggest. Since then, it's essentially been cut in half down to around 20. So a much more normal level, and that's happened in a matter of weeks. So really seen that collapse and taken a lot of the uncertainty out of the market there. Other things we've seen are interest rates starting to trend back up. So we bottomed about 0.5% on the U.S. 10-year Treasury in March, starting to flirt with 1% again, which long-term, historically, that's still pretty low, but I think the trend is significant here. Higher interest rates usually happen because growth prospects long-term are better. In terms of another way to look at interest rates is in terms of their level relative to each other. So a short-term Treasury, a 2-year versus a 10-year, or a 5-year versus a 30-year. So that's what we're looking at with the brown line, the 5 years versus the 30. The yellow line is the 2-year Treasury versus the 10-year Treasury. And again, the higher the interest rate, the longer term bond, higher rates, is sort of called a steep yield curve. If it's flat, or if you're getting paid more for a short-term bond versus a long-term bond, that's inverted. And typically, inverted is a sign of the economy slowing. A steep or upward sloping yield curve would be a sign of the economy growing. So what you're seeing here is from March to now, the yield curve is getting steeper. You're getting paid more for longer term bonds and shorter term bonds, and that spread has been widening over that period. Other way to look at this is just in terms of credit spreads. How much are you getting paid to take on some credit risk over treasuries? So here you're looking at high yield in the pink and just regular corporate bonds here in the green. And what you can see here is widened quite a bit through March and April and have really just come down, especially on the high yield. On corporate bonds have really sort of flatlined and become more normal over time. So this, again, a suggestion that things are stable and set up for a growing economy going forward. The other thing to look at here would be commodities. So here we're looking at gold, copper, and oil. Again, copper and oil have been doing better over the last 6 months than gold. Gold is more, a hedge. Oil and copper are more pro-cyclical. So as the economy expands, you would expect these to do better. And again, this is what we're seeing. In the equity markets, we can look at this in sort of two different time frames. One just post-election, and what you're seeing over that period is these areas of the market that didn't do as well early in the year, small cap, value, have been doing better over this period. So the S&P 500 up about 3.5%, and then the technology stocks, QQQ here, actually down slightly over this period. So you're seeing a reversal there where some of the areas of the market, again, small cap and value, doing better over this period. If you go back to September, this has kind of been happening over the last few months. So you see a similar thing, small cap value, best performing area, at least of these four over this period, followed by large cap value, followed by the S&P 500, and again, technology stocks, again, down about 3% over this period. So this is, 2.5 months now, technology stocks have actually been down. Some of the other areas of the market are up. So again, this is a reflation trade, you call it different things, but there's a sort of a rotation in the market that's been happening since then. So just a brief summary of all this, where we are today. So lower uncertainty, some of that's just with the vaccine, some of that's with the outcome of the election. Still a potential for stimulus, which would be good for this reflation trade. Again, good for growth, at least that's what the market's pricing in. Vaccine, positive news on the economic growth perspective, higher rates, and at least over the last couple of months, a value and size comeback in terms of areas of the market. So that's what's going on here in the market of late, certainly post-election, and just some interesting things changing, some areas of the market outperforming that hadn't outperformed earlier in the year. Lastly, to our trivia question. So interestingly enough, from the bottom of the market, March 23rd, Pfizer would have actually been the worst bet out of all those areas of the market. So pretty hard to fathom. The company that comes up with the vaccine, gets it tested, and looks like it's a front runner from it, actually underperformed a lot of the other areas of the market. So best performing by a whisker here, small cap value. So some of the companies that were most beaten up, most affected, actually better buy over this period slightly than technology stocks, and a better buy than the largest 500 companies in the US. So I think goes to show, interesting trivia question, but also just goes to show that investing is difficult. It's tough to pick winners, and better to stick with the strategy and stick with the things that work over the long term. It's really hard to pick names, even if you knew in advance that Pfizer was going to be the place to be, doesn't mean it's going to be the best investment. So that's it. That is our investment update for today. Hopefully this is helpful. And as always, let us know what questions you have, what topics you'd like us to cover here. All right. Have a good afternoon. Thanks for watching. Bye.